If you've been scrolling financial headlines today, you've probably seen some version of this story already. Silver beats Apple, $4 trillion. Warnings flashing for Nvidia. The tone is urgent, dramatic, and designed to make you feel like you're late to something big. And I get it. Those headlines are attention-grabbing on purpose. But headlines aren't analysis. What we do here is slow things down, strip out the emotion, and look at what's actually happening underneath the noise. My goal over the next 20 minutes is to give you clarity, not adrenaline. We'll talk about what the data really says, what it doesn't say, and how I'm positioning around it personally. This is Financial Briefing, and as always, we're here to think clearly when the market is trying to make us react. Before we dig into the numbers, I want to do a quick check-in on accountability. A few months back, when silver was trading around $26, I said a move into the low 30s was more likely than not if industrial demand stayed firm and real rates stopped rising. We're now sitting around $32 to $34, depending on the day, so that played out. Earlier this year, I also said gold would likely stall near 2,400 before consolidating rather than running straight to new highs. That pause happened almost exactly as expected, and I'll also own the misses. Last fall, I underestimated how long equity multiples could stay elevated in mega-cap tech. I expected a deeper pullback that didn't materialize. That's part of the process. The point isn't perfection, it's transparency, so you can judge whether the framework holds up over time. Now let's talk about the data that's driving these headlines. The first number getting everyone excited is the implied market value comparison. When people say silver has beaten Apple, what they're really doing is comparing the estimated above-ground value of investable silver to Apple's equity market capitalization, which recently hovered just under $3 trillion before pulling back. Using conservative estimates of roughly 60 billion ounces of above-ground silver and spot prices around $33, you can get a notional value north of $2 trillion. Some more aggressive estimates include jewelry, industrial stockpiles, and higher assumed prices, pushing that figure toward $4 trillion. Historically, silver's above-ground value has almost always been far smaller than major equity markets. So in that sense, the comparison is unusual. What it means is that silver prices have risen enough to force people to pay attention again. What it does not mean is that silver has somehow replaced Apple as a store of value, or that capital is rotating one for one from tech stocks into bullion. These are very different markets with very different liquidity profiles. The second data point is silver's performance relative to equities over the past 12 months. Silver is up roughly 40% year over year. Apple, depending on where you measure from, is flat to slightly negative after a strong run earlier. Nvidia, of course, is still massively positive, but volatility has increased. Historically, periods where silver materially outperforms large-cap equities tend to happen when real yields stop rising and growth expectations become less certain. We saw similar relative performance in parts of 2010 and briefly in 2020. What this means is that silver is behaving like a hybrid asset again, responding to both monetary conditions and industrial demand. What it doesn't mean is that equities are entering a crash phase. Relative outperformance can happen without absolute declines. The third data point is supply-demand balance. According to industry estimates, the silver market is running a physical deficit of roughly 150 to 200 million ounces this year. That's meaningful. It's larger than the average deficit of the past decade. Historically, sustained deficits have supported higher prices, but often with long lags. What this means is that the price move we're seeing isn't purely speculative. There's a real tightening in physical availability. What it doesn't mean is that shortages are imminent or that industrial users are about to panic. Most of this deficit is being absorbed gradually through inventories, not through visible stress in supply chains. So where does that leave the bullish case? There are a few reasons why silver could continue higher from here. First, industrial demand tied to electrification, solar, and grid infrastructure remains strong, and those trends are structural, not cyclical. Second, if inflation stays sticky while nominal rates drift lower, real yields could fall further, which has historically been supportive for silver. Third, investor participation is still relatively modest compared to prior bull markets. We're not seeing the kind of retail frenzy that marked previous peaks. And fourth, silver is still cheap relative to gold on a historical ratio basis, even after this run. Put together, a continuation scenario where silver moves into the high 30s over the next 12 months is plausible. I'd put the probability of a clearly bullish extension at around 25%. Now, let's be just as clear about the bearish case. Silver has already moved a long way in a short time. A 40% annual gain is not trivial. If global growth slows more sharply than expected, industrial demand could soften. If the dollar strengthens meaningfully, that would also be a headwind. Another risk is positioning. Even if we're not at extremes, momentum Traders can exit quickly if the trend stalls. And finally, if equities, particularly tech, reaccelerate higher, capital could rotate back out of metals. In that scenario, silver could easily retrace back toward the high 20s without breaking the longer-term trend. I see the probability of a bearish or disappointment outcome around 30%. That brings us to the middle case, which is where I spend most of my time. The most likely outcome, in my view, is consolidation. Silver holds above $30, trades in a wide range between maybe 30 and 36, and digests the gains while fundamentals catch up. This would frustrate both the extreme bulls and the aggressive shorts. It would also fit well with a broader macro environment of slowing but not collapsing growth and gradually easing financial conditions. I assign roughly a 45% probability to this kind of sideways to higher scenario. To understand why I'm cautious about extrapolating too much from the current moment, it helps to look at history. A useful comparison is the 2010 to 2011 period. Back then, silver surged from under $20 to nearly $50. The similarities are obvious: concerns about monetary policy, strong investment demand, and industrial growth narratives. But the differences matter more. In 2011, retail participation was extreme, leverage was rampant, and monetary policy was far looser relative to inflation. Today, regulation is tighter, leverage is lower, and central banks are still cautious. That doesn't mean silver can't go higher. It does mean the path is likely to be more uneven and less euphoric. Cross-market signals help keep us grounded. Gold is currently trading around $2,300 to $2,400, holding gains but not breaking out aggressively. That suggests monetary hedging demand is steady but not panicked. The dollar index has been range-bound in the low 100s, which is neutral to slightly supportive for metals. The 10-year Treasury yield, sitting around 4%, has stopped rising but hasn't collapsed. Together, these signals point to a macro environment that's supportive but not explosive for silver. There's no confirmation here of a crisis trade. Positioning data adds another layer. The latest COT reports show managed money net long silver futures, but well below the extremes seen in prior peaks. Commercial hedgers have increased shorts modestly, which is normal at higher prices, but not aggressively. Banks appear to be facilitating flow rather than taking strong directional bets. Institutional behavior looks cautious, not euphoric. That's generally a healthier backdrop than what we see near major tops. So how am I personally handling this? I'll be specific. If silver breaks and holds above $36 on strong volume and improving macro signals, I'm willing to add modestly increasing my allocation. If silver falls back below 29 and stays there, I'll reduce exposure and reassess. Right now, my portfolio is roughly 10% precious metals, split about 7% silver and 3% gold. I use a soft stop around $28 on my trading positions, not on long-term holdings. On the upside, I'd consider trimming into the high 30s rather than swinging for a home run. This is not advice, it's just my framework, shared so you can see how I think through decisions. Just as important is what I'm not doing. I'm not panic buying because of headlines. I'm not binge watching fear-driven content that frames every move as the end of the system. And I'm not assuming that a strong silver market automatically means an equity collapse. Markets are more nuanced than that. As we head into the rest of the week, there are 3 things on my watch list. First, price behavior around $35. Acceptance above that level would be constructive. Repeated rejection would suggest consolidation. Second, the dollar index. A move above 105 would be a warning sign for metals. Continued range-bound action would be fine. Third, equity volatility, especially in Nvidia and other megacaps. Rising volatility without follow-through selling would support the middle case scenario. Disorderly selling would change the calculus. Let me wrap this up simply. Silver has had a strong run, supported by real fundamentals. The comparisons to Apple make for great headlines, but oversimplify what's happening. The bullish case is real but not dominant. The bearish risks are there but manageable. And the most likely outcome is consolidation with a positive long-term bias. If this kind of balanced, data-driven analysis is useful to you, consider subscribing. It helps the channel and it tells me this approach is worth continuing. Thanks for watching Financial Briefing. Stay sharp.